It's easy to run and grow your business when the conditions are favorable. But what happens when there's an economic downturn? How can you use life insurance policy loans to help run and grow your business during times of turbulence? Hi, I'm Olivia Kirk.
I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
According to a U.S. bank study, 82% of businesses fail due to cash flow concerns and cash flow issues that hold them back.
And that same study also found that loan rejection rates increase by 30 to 50% during an economic downturn.
So cash flow is down. Your access to money is down. How do you continue to grow and run your business during these times?
That's why we advocate very strongly that you position yourself for that ultimate downturn in the economy. Think about it. It's factors that are outside your control, and you have to prepare yourself to be able to weather that storm. What better way to do it than to have access to capital? You see, access to capital trumps everything. When you have access to capital, opportunities will find you.
You know, you'll hear people talk about scarcity and abundance mindset, and it's real easy to talk about the abundance mindset, except when you actually feel like there is a scarcity when it comes to cash, access to cash, and cash flow. So it could be real easy at that time to hunker down and try to get through. But if you have the foresight to build up cash reserves in a life insurance policy, for example, you are actually going to be in a position where you will have an abundance. You will be able to use that money for whatever you want, right? Because there's not limitations on how you use life insurance policies loans. There's not qualifications on whether or not you're able to access that money. The only requirement is that you have the money built up in your policy, and then you're able to use that life insurance policy loan provision to access that money to weather that storm.
And keep this in mind. Your financial situation is going to be compared to everybody else, all of your competitors, all of your peers. And if you have access to capital at a time when they do not, it's going to put your business in a much stronger position so that you could actually take advantage of all of the bad things that your competitors are going through and maybe have some opportunities that you wouldn't have had access to previously.
Right, because if cash flow is tight, it's going to be hard to hire new people. It's going to be hard to meet payroll. It's going to be hard to invest in new equipment and technology, which is more important than ever these days. And if you have access to money, you're going to be able to do all of those things where your competitor who isn't necessarily prepared is going to have a more challenging time.
And that's the point of having access to capital. And life insurance fits the bill so well because you have two things going on. Yes, you have a death benefit, but you also have an ever-increasing base of capital. It's guaranteed to have more cash next year than it did this year, and it's guaranteed to have more cash the year after next than it does next year. So consequently, you have this perfect compounding where the money is continuing to increase year after year after year, and all you're doing is putting the same amount of money away. And that gives you the access to capital that you need to run and grow your business.
It all comes down to the design of these policies. First of all, they're designed for cash value accumulation, so early access to cash in the beginning of the life of the policy, which is unique to life insurance policies because typically with a whole life policy, it takes several years until there's any cash value you could borrow. Also, with the whole life policy, you're designing the policies with actuaries. They're actuarially designed to get better and better with time. As you get closer to the end of your life expectancy, the cash value needs to grow faster and faster in order to meet the two promises. The first promise is to pay that death benefit out anywhere along the line as long as that policy is enforced. And the second promise is to have a cash value that's equal to that death benefit at the age of maturity, which is typically age 100 or 121. So in order to meet that second promise, the life insurance company needs to stash away more and more cash year over year so they can meet that second promise.
And see, that's all part and parcel of having access to capital. And as the policy grows, as time goes by, the cash value grows greater and greater. And let me just share how a client of ours used this. We set up a policy for them in the late 1990s. And then around 2007, and they weren't, by the way, they weren't putting a lot of money into the policy. I think it was like $300 per month. But as time went by, during the financial crisis, they had an opportunity to start a business, but they needed capital. So they called and said, hey, do we have enough money in our policy? You said we could borrow against the cash in our policy. Do we have enough cash value to borrow $5,000? And sure enough, they did. Well, they were able to access that money, no questions asked. And that was the thing that sort of amazed them. They just called the insurance company, and the company didn't ask them what their credit score was. They didn't ask them what they needed the money for. They just said, where do you want it? How much do you want? And that was it. And so consequently, they had the money. They opened up this business. They used the money to start a business. And now that business is worth $400,000. And now they're at the point in their lives where they're going to sell the business. So think about all the income that they generated over those years. And now they're going to sell that business for maybe $400,000, maybe $350,000. That's an incredible rate of return on a $5,000 policy loan.
Exactly. And it's one of those things where they didn't necessarily know what was going to come up, but they knew that they, number one, wanted that death benefit, and number two, liked having the ability to access that cash if they ever needed to. So by taking those steps, even without knowing exactly what they were going to use that money for, they were able to take advantage of the opportunity when it came knocking on their door. If you'd like to learn more about putting this system to work for you, your life, your business, your family, be sure to visit our website at tier1capital.com to schedule your free strategy session today. Also, if you like this video, be sure to give us a thumbs up and check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep. That really matters. We'll see you in the next one.